out of Cleveland, Ohio. As chief architect of the firm's investment strategy, Roger has conceived and developed a proprietary ranking and rotation methodology that functions as a barometer which fuels the growth of his clients' investment portfolios. Roger's past life includes nearly 3 decades serving in a professional consulting stints at McDonald Investment and Swiss Barty before shedding the corporate barriers to success and starting up his own client-centric, fee-based consulting firm. He advises high-net-worth individuals on how to protect and maintain their investments while assisting directors of corporate retirement plans with helpful tools to grow the net worth of participating plans. Roger is a regular contributor on CNN Money and writes investment articles for such trade publications as Medical Economic News, Agency Sales, The Wholesaler. He's addressed a host of professional organizations nationwide, including the Akron Bar Association, Financial Executive International, Association of Independent Manufacturers Reps, and the Power Motion Technology Rep Association. Roger lives in Avon, Ohio with his wife and 2 children, and when he's not vying for fame and fortune, utility competing in hot sauce contests, you can find him running around town training for triathlons. And so, here to give his 2 cents worth of individual invaluable investment advice, I'm very pleased to bring out Roger Balser, the go-to guy for agency sales.
Thanks, Todd.
You're welcome.
Thank you. Is Chris Coleman in the room? Oh, Chris, you're going to be upset. Just lost out. Chad Jeffries. No Chad? Well, this isn't starting out for a while for anybody. Chad just lost $100. Clint Edwards. Clint, you are the man. Please walk up here.
Nice. Yeah, how did that happen?
How did that happen?
We actually sent an email out to everybody back in December. And if you were by December, it said, yes, the Dow closed as of yesterday. Well, the first 2 didn't bother to show up, so they lose out. Clint,
Nice.
put your hand up, my friend. 20, 40, 60, 80, 100. Now, I want to ask you one question. How did you guess? What was your thought process? What was your investment philosophy to get to the $100 and to figure out what the market was going to close yesterday?
Wild ass guess. I knew that it was 16 something before the end of the year, and then I thought, well, it's probably going to taper off after the first of the year, so that was it.
Give Clint a hand, everybody. You see Clint at the bar? He's buying?
Yeah, that's popular, right? Thank you.
You're welcome. Thank you. Basically, that's the same question that I was asked by my mentor back in 1999. And it was, Roger, what's the market doing? How do you process things? How do you choose stocks? And my answer to him was, well, it's a guess. I have no clue. I do not know anything about the market. Mind you, I started in the investment business in 1985. This was 1999. The market made a turn for the worse in 2000. Will actually set me down and he said, Roger, I'm going to teach you an investment process that saved my career and may save your career. What you will learn is the exact investment philosophy that Will taught me in 1999 that saved my investment career and in 2008 had my clients' investment portfolios profitable. Once again, they were profitable. It's called point and figure charting. What point and figure charting is, it's an antique philosophy that's been around for 100 years. We're going to learn how it works, and then we're going to figure out are we in a bull or bear market at the end. Point and figure charting was actually started by this young chap right here. That's a picture of Charles Dow. He was the first publisher of the Wall Street Journal, and he created the Dow Jones Industrial Average. Now what Mr. Dow did was he actually was what's called a fundamentalist at heart. What a fundamentalist is somebody who takes a look at a stock, and it's somewhat like what Warren Buffett does. He takes a look at the earnings. He tries to forecast where it's going. He tries to figure out exactly what's happening in the marketplace, and then he makes his investment ideas. But he also was very concerned about the supply and demand relationship of what was happening with the stocks. He would take this investment philosophy that he really did not but actually this investment philosophy that he did, he used for himself, for his own edifice, for his own portfolio. I always like to throw this in the beginning. This is actually a picture of a guy, could be one of you guys, I hope it is not, but what I want you to notice, the guy's sitting there and he's talking to himself, or talking to his boss on the phone. What I want you to notice is on the supply side. The supply box is full, the demand side is down. Has anybody ever bought a stock and seen it go south? Seen it go directly down? Todd mentioned he buys things high, sells them low. That's exactly what happens. He says we have a slight problem. What the problem is there's no demand. Now there may be a fundamental reason for why the stocks go down. But really when you boil it down to the simplest form, it's supply and demand. No matter whether you're selling food service equipment, or whether you're in the investment world, or selling cars, does not matter what you sell. If you're sitting there and there's no demand and little supply, guess what? What way's price go? Goes down. There's no other way to put it. And it's a very simplistic philosophy. That's what the investment world basically is all about. If there are more buyers than sellers, price must rise. If there are more sellers than buyers, price must decline. And if buying and selling are equal, price must stay the same. You now know more than 95% of the investment advisors and stockbrokers out there in the world. That's how the investment world works, bottom line. But what Charles Dow would do is he actually would have a chart that looked exactly like this. Does this chart make any sense to you? Really, if you take a look at it? No. By the time we're done, it will make sense. Basically what Charles Dow would do is he would take a chart, a piece of chart paper, and what he would do is he would just pull out any part on here. Let's start at the 46, and it doesn't matter what stock you're looking at. He'd start at 46 and say the stock went from 46 to 54, and he would write down 46, 47, 48, 49, 50, so forth, up to 54. And then let's say it just hovered there for a while. And then all of a sudden, the next day, the stock went to 53. So he would write down 53, and then he would go 52, 51, 50, and he would move down. Now what he did that was unique here is he would change columns, because you cannot overwrite the column in which you just wrote something on. But the problem with this kind of chart is, yes, you can see it's going up, but you don't know who's in control. You don't know if supply's in control or demand's in control. This could be the chart of any stock. This actually happens to be a chart of Apple stock. Way back in the day, not today. This is what Charles Dow used to use. And then in the 1920s, they changed everything. They made a big change on everything. And what they did is they said, you know, we can't read those charts. We don't understand exactly what they're saying, but they're showing us different things. So they went and they said, we're going to make this chart, and this is a chart exactly as it is today. Has not changed since the 1920s. And what you have on here that's very important, they put X's and O's. What the X means is the demand is in control. And the O's mean supply is in control. Does that make sense on those two? Can you read this chart much easier than you could read the previous chart? It's all unemotional. What they did then is they said, we're going to alternate columns of X's and O's. And you need a minimum of 3 X's or O's to change columns. That's what's called the 3-point reversal method. I'm going to get a little technical here, but if you have questions, please fire them out at any time. What the 3-point reversal method is you need to have at least 3% or 3 points or 3 boxes to make a change from one side to the other. What that does is it gets away from what's called the noise. So in this case, this is actually a chart of Apple, and I'm going to kind of go through this chart to give you an idea. What they did is this is the years from 12 through 13, 2012 through 2013, and these are what they put on the side, is they put the price on the side as opposed to having the price of just the figures on there. The charts that Charles Dow did were called figuring. These charts are now called points, so they put them together and said we're just going to name them point and figure charts, or P and F for short. But on the left-hand side, you can see we go from $310 all the way up to $720. You can make the size of the box any size you want. Back in the old days, they used $1. You get a stock like Apple that's $400, $500, $600, $700, you use a $10 chart, or a $10 box size. What you do is, once again, to give us more of an idea, this means that to rehash supply is in control, that's demand is in control. As you see on here, there's a lot of numbers and letters. We've got 1, 2, 3, 4, 5, and 6. What they did to make the chart easier to read was they put in January. So number 1 is for January, 2 is for February, 3 is for March, and so forth down the line. And then when we hit October, they use the letter A, then B, then C. And what you're looking at on this, if you look at this chart, what do you think is happening now? Anybody? It's falling, right? Here it's falling, but right here, where you see the B, it just broke through onto the upside. So it looks like it may be going up. This line right here is what's called a support line. And if you're talking to somebody who's a technical analyst, which I happen to be, if they mention a support line, what a support line is like a concrete wall. A stock will go down, hit the support line, bounce up, hit the support line, bounce up. What that support line does is it stops you from selling stocks as they're going down and bouncing back up. Has that ever happened to anybody? Bought a stock, you sold it, and then all of a sudden you go, son of a gun, I should have sold it. And then it's up. Because what it did, it hit the support line and bounced back up. And what this top line is called, that's the resistance line. Once it breaks through the resistance line, it's basically home free. It's going to go up. Now it may hit the resistance line and pull back down. So it works in both different directions. You now can read a chart. This is very, very important. And in using this, what the best part about it is, we only use the highs and lows. People ask me, how can you be out doing presentations during the day when the market's open? We don't care what's happening in the market during the day. We only look at the closing prices. So all the noise of something going up and down, up and down, up and down, up and down, we don't even look at that. We look at what's happening at the end of the day. This is actually a flow chart that we use and that I use to chart over 250 stocks a day. The computer can do it that quick in a matter of seconds. I do it by hand still. People say, Roger, why do you still do it by hand? Because it gives me a flavor. It lets me know what's happening. If I'm doing it by the computer, I'm not really looking at the chart. When I do it by hand, I'm looking at 200 to 250 charts a day. I can get a flavor for whether something's basically breaking out or whether it's falling through the floor or going over a cliff, which you'll see a few things of falling over a cliff. And what we do is we check the daily low. This is in a column of O's, which means what? Anybody? Selling. Supply is in control. So if it's in a column of O's, what we do, and you can pick out any stock you want, we check the daily low and we say, did it fall? The answer is no. Did it reverse up? Now if it reverses back up, we need a what? 3-point reversal to change, to basically change what's happening with it. If the answer is no, then we just move on to the next chart. There are certain days that we just don't do anything. Nothing happens for specific days. Sometimes it can be months that nothing happens because it's going up and down, up and down, up and down. It's just noise. And there's no reason to do anything. But let's say stock did reverse up on its chart. We then move over one column and place an X in the boxes. And then we go down, move on to the next chart. Let's say it fell. We put the appropriate numbers. Let's say it had 10 on the box. We put the appropriate numbers in the box and we watch it fall down. So this will help you do the charting. You can do this charting on your own. You can go to stockcharts.com, put it in there. The computer will do that for you. It is free service. You can call me. It is free service to call me a few times. If you start calling me every day and then saying I'm buying and selling this and you're making a lot of money, we got a problem. But what we use when you're doing this kind of gives you a flavor for doing it. And it doesn't take a lot of time. As I mentioned earlier, I do from 200 to 250 stocks in 30 minutes. That's not a lot of time to work. And it's not emotional. That's the big part. Most people get emotional when they're investing. This has no emotion involved with it whatsoever. This is a very important part here. And if you don't get this part, you're going to miss out on almost everything. There are basically two signals that you see. These are the two most basic signals. One's called the double top and the other one's called the double bottom. If you're watching on CNBC and you hear somebody say there's a double top move that's happened or a head and shoulders move, which, God, I don't know what that is. That's a different charting system. But these are very simplistic and very easy to read. When you see these things happening, what a double top is, it is a column of X's exceeding a previous column of X's. That is the most basic buy signal that you can see that is in green. Well, once again, if you go back to the Charles Dow information, he would have had these put in with just figures. We have them put in with the X's and the O's. This specific stock went from 39 all the way down to 31. May have stayed at 31 for months, weeks, years, who knows. And then all of a sudden, that supply-demand box, that demand box starts getting full a little bit. Then it gets a little fuller, becomes even. Then all of a sudden, the demand box becomes more, and you get the 3 X's. Now this stock could have gone from 32 up to 33 3/4, and we would have done nothing. We would have done absolutely nothing. Once it hit 34, we still haven't done anything because it's not a buy signal. It's just showing demand's in control. Then it reversed back down, and then all of a sudden it reversed through, broke through to 35 and became a buy. That's what's called a double top buy signal. It is the most basic pattern in technical analysis, and you will see this over and over and over again. Now there are other signals that go off of that, but these are the 2 basic ones. The double bottom is just the opposite. It's a column of O's exceeding a previous column of O's. Same concept, same stock, got your column of X's, reverses over, comes down from 37 to 35, buying pressure comes back in, goes from 36 to 38, then selling pressure comes in at 34, you would have actually sold the stock at 34. Does all of this make sense? Sounds very simplistic, which it is, but there's no reason to make investing complicated. You see these guys on TV that come out and they will tell you, this is going to happen, that's going to happen. They're forecasting. I was actually mentioning to Todd earlier, I was out in Albuquerque, New Mexico, speaking to AMAR back in September. And they had an economist that was on there, and the economist said, we are going to have a market that is going to go down from 15 to 30% in the next 3 to 6 months. How does he know this? How does anybody know that? That was September. Boy, if it's going down, it's got a long way to go from then, because the market's done nothing but continually go up since that point in time. Nobody holds these people accountable. We do not forecast. We do not forecast. Clint was great. If you want to know where the market's going, call Clint, because he did a fabulous job, and it was a WAG. That's what most of these guys on TV are doing. That's what most of these investment advisors are doing. What point and figure charting deals with? It deals with what is happening today. Not with what's happening in the future, it's what's happening today. We can tell you the best places in the market to be today, and that could change tomorrow. Usually it does not, because these are actually long-term signals. This is one here that I always like to put up. It's called paying attention. What this is actually a chart of the housing starts. You can use point and figure charting, not with just individual securities, but we use it with a lot of different economic numbers that we receive. And if you look at this one, this is housing starts. There's a few key areas that I want to point out to you. This chart actually goes all the way back to 1976. Remember where I talked about a lot of the noise happening? This is a chart from 76 through 2013 on one sheet of paper. A lot of information on this. But what you're seeing is from 1976 all the way through to April of 2006, the housing market was basically trending straight up. Straight up. 2006 in April, guess what happened? What's this signal right here?
What?
That's a sell signal right there, where the number 1 is. And then it proceeds to go all the way down. We did not know anything was happening. We did not know the housing market was going to crash. We did not know there was anything that was transpiring or happening with the Federal Reserve, with mortgages. We did not know that was going to happen. But what we did know is housing starts all of a sudden from 1976 to 2006, a 30-year period, all of a sudden made a sell signal, which I said, you know what, you better pay attention. You better start taking a look at things. It goes all the way down. We then move to June of 2009. Guess what happens? The media is out there telling you that the housing market is down, you should not be in real estate, and all of a sudden, housing starts go up and make a buy signal. Nobody knew this. Nobody's following this information. And then November of 2011, we've got a little bit of noise that happens here. November of 2011, second buy signal happens. Our clients were paying attention. We were paying attention for them. And all of a sudden, we said, we need to start taking a look at this. We need to take a look at the housing starts. We need to find a way to make it profitable for our clients. So what we do is, we go in and we buy what's called an ITB. What ITB is the symbol for the iShares Housing Index. It was the Home Builders Index. We actually bought that on the 18th of 2011, sold it July of 2013 on the 25th. We're up 112%. The market was up 39.22, the S&P. Just by paying attention to something that most people out there are not paying attention to, we were able to produce for our clients a substantial rate of return on something that if you watch the media, and if you watch the magazines, and you read the Wall Street Journal, you watch Jim Cramer on CNBC, and his wild and screaming and jumping up and down and telling you the housing market's going to hell in a handbasket, they were wrong. They were wrong. This is something that if your broker's not paying attention to these different areas, you need to find somebody who will. We actually did, back in the meeting in Albuquerque in September, we talked about the domestic oil, which I don't have a chart of it up here now, but with domestic oil, I just shot out an email to the folks from AMAR. CNBC came out with an article talking about how domestic oil production now, guess who the number one supplier to the U.S. is? The U.S. is the number one supplier to the U.S. We were talking about this all the way back in September. Go to my YouTube videos, which is called the 2 Minute Tuesday, where every Tuesday I try to put up a little 2 minutes, sometimes it goes to 3, and I just try to give you a flavor for what I see happening in the market and different ideas like this that lets you know that we're paying attention. And in August, we were talking about domestic oil production. Not a recommendation, but one thing that's out there, if you're looking at the fracking industry, which has been doing that, there's an index called FRAK, F-R-A-K is the symbol on it. There was also the Business Week had an article that same week that had a ship on it that said holy ship, which was telling you the shipbuilding industry was not the place to be. But yet, if you looked at the Baltic Index, which is all the shipping that's transpiring of the dry goods, that was actually on a buy signal. We took a look at another index of the symbol SEA, and we bought that. Now, those are different things that you're not hearing people talk about. Everybody's talking technology, technology, technology. These are the old standbys, the things that Dennis Gartman calls, you drop them and they hurt your foot when they hit your foot. These are ideas that if you're paying attention, you can actually make your portfolio profitable. And there are different economic indexes that are out there. Little quiz for you. Kind of make sure everybody's awake and in here. Supply or demand, which is in control? Supply. Would you buy this stock or would you sell it? Probably sell it because broke through here in July, went straight down. This is actually a chart of Citigroup, the big financial services company that used to own Smith Barney, that is now owned by another firm, and all these firms have all gone together. If you look at that stock actually went down to $6 per share. If you would have looked at it there, looking on there, it would have been, what, $48 you would have sold it, where it broke through the resistance line on the downside, on the support line on the downside. Just a way, unemotionally, that you can use to protect your portfolios. This is a question I get from a lot of people. Everywhere I go, they find out I do investments, and they go, what's the market doing? And my question always is, what market? And they go, well, the one you hear about on TV, that S&P thing. And I go, well, which S&P? Do you know that there are 2 S&P 500s? They trade the same, or they trade differently. They have the same stocks in them, but there's two of them. The one they talk about on TV is called the S&P 500. It's cap-weighted. What cap-weighted means is, and I use a comparison between Congress and the Senate. What cap-weighted means is Apple is 4% of the move that happens in the S&P 500. So if Apple moves substantially, the S&P 500 is going to move substantially. If Apple drops substantially, the S&P 500 is going to drop. Good old U.S. Steel is 0.006% of the S&P 500. Now there's a different one. That's the one we call the Congress. Congress is represented by, anybody in here from California? No? Anybody here from Rhode Island? No? What you have with Congress, Congress has representation based upon the number of people that live in your state. The S&P 500 that you hear about on TV, that is the cap-weighted S&P 500, is based upon that type of a representation. California has more representation than Rhode Island. The other one, and the more important one, as of today, is called the S&P 500. It's an equal weighted. What equal weighted means is one stock, one vote. Same thing as the Senate. Wyoming has as many senators as California, as Ohio, as Florida, as whatever other state you're choosing. There's equal representation. That's called the equal weighted index. And by knowing which one of those indexes to buy since 2000, you would have made a substantial difference in your portfolio. Substantial difference. Back in the 1990s, you should have owned the S&P cap-weighted index. We did a calculation called the relative strength calculation, which I will show you exactly how to do. It's fourth grade math. And if you can't do fourth grade math, go find a fourth grader and they'll do it for you. It's very simplistic. But basically, by knowing which one to utilize, all of a sudden, bells went off. We were paying attention, and in 2000, we saw it change. And it told us to start concentrating on the S&P equal weighted index. This is a hypothetical growth of the S&P equal weighted index of $10,000 invested in 1999 through, on there is November of 2013. Does not include dividends or any commissions or fees. Which one would you like to own? Commissions, we're expensive. We're expensive. But if you take a look at this, the S&P equal weighted index was up 142.78 versus the S&P of 20.33. So just knowing which S&P index to buy could have made a substantial difference in your portfolio. Has anybody ever heard, or have your advisors, or did anybody know this existed beforehand?
No.
Why aren't they talking about this? More people should be educating their clients and their clients' friends and everybody else about this. Substantial difference. So the next time you're talking to somebody or hear somebody say, this is what the market's doing or the S&P, or even if you probably don't have those conversations as often as what I do, but if you have that conversation, bring this up. Say, which S&P are you talking about? Did you know there's two? Or even go back, and if you have an advisor or a broker, ask them. Say, John, did you know that there are two S&P 500s? And I will be willing to bet you their answer is going to be, what? There are?
In other words, run.
Pardon me?
In other words, you should run from that person.
I can't tell you what to do, but yet, there's the old thing, in Cinderella they said, if the shoe fits, wear it. So if you think through that process, that may be a good idea. Because what's that tell you? What's that tell you? It's Libby, right? Libby, what's that tell you?
It tells me I'm dealing with a professional.
Exactly. It tells you that you're not dealing with a professional, as Libby said, and number two, they're not paying attention. Now, we don't know everything. I'm not saying that. We do not know everything. But boy, if you're sitting there and the guy's saying, we're comparing it to the S&P 500, which if you compared everything to the S&P 500, you had a 21% return last year, or over this period of time, and you're a money manager, guess what? You got a bonus. You got a bonus. Well, shouldn't you get a bonus to to outperform the S&P equal weighted index? You've heard of benchmarks. Everybody has benchmarks in everything that we do. When the investment world, most people will use the S&P 500 as a benchmark. My clients use the S&P equal weighted index as a benchmark. So I kind of compare it from a sports analogy to where I have Peyton Manning as my quarterback, who is probably one of the better quarterbacks, or Tom Brady, throwing out the guys that are out there now, versus having what the Cleveland Browns, our beloved Cleveland Browns, have. We don't have a clue who the hell's playing quarterback. These guys are not paying attention. Very, very important. Thanks for bringing that in on that, Libby. I had mentioned to you about relative strength. Every sports team has rankings. We just got rid of the BCS ranking, so I'm going to have to take this out because they're not using it anymore. But every sports team has rankings. You guys have rankings. I know every company has rankings. Everybody is ranked against each other, right? You know, it's not like picking the National Basketball All-Star Game where they base it upon who they like. It's based on rankings. The point and figure chart that we use in the relative strength is a ranking system. Very simple calculation. What we do is we take the stock price and divide it by an index. In our case, we use the S&P equal weighted index because that's the benchmark we're using. We multiply it times 100 to give us our relative strength reading. Then what we do is, the chart you saw in the beginning, we then plot it on a point and figure chart. And it will tell us who's in control, supply or demand. So if you're sitting there and you tell me, what are a couple of the companies that trade on the New York Stock Exchange in your industry? Isn't it Manitowoc? Yeah. Okay. You can take that stock and you can take another stock and compare it versus Apple. And I can tell you immediately today which stock you should buy. It's based on relative strength. You're buying the strongest performer of that day. That may change. These relative strength readings don't change on a daily basis. The signals that they give are anywhere from 18 months to 24 months. So they're long-term in nature. It's not something that is moving very quickly. And we then plot those on a chart. Golf rankings, they also do the rankings. So give you an idea to kind of change it to the sports idea. If you're watching golf where they play the Honda Classic down here, let's say Tiger Woods is golfing, Phil Mickelson's golfing, and pull somebody else out of the hat that I'm trying to think of somebody now out of nowhere. And who are you going to bet on? You have to bet on somebody. Who are you going to bet on? Probably going to bet on Phil to win, or you're going to bet on Tiger to win, or you're going to bet on the top 10. Because usually you're going to at least get your money back, if not make more. That's all relative strength does, is we rank everything. Is this making sense to anybody? Any questions out there? Sound simplistic? Can you do this at home? Yeah. So really you don't need a broker if you have time. But let's go back to the original example I showed you with the S&P 500 and the S&P equal weighted. Show you how we can take it a step further. Using relative strength, we repackaged the S&P 500. What you have on the left-hand side, that is a relative strength chart from 1994 through 2011. Remember what I said, they're long-term signals? That is a chart, 16 years? Almost 17 years, that's a chart right here of 17 years. What we did is we compared the two, plotted them on a point figure chart, and what that told us was whether we should own the S&P 500 equal weighted index or the S&P 500 cap weighted index. This is the equal weighted index, that's the cap weighted index, the SPY is. Those are the symbols that you see come across on the ticker tape. They bring them across the screen. In the red, you should have owned the, when you're in the red signals, you should own the SPY. When you're in the purple, you should have owned the RSP, which is equal weighted. Taking it from 1994 on December 31st all the way through May 10th of 2000, you'd have been better off being in the cap weighted index. You'd had a return of about 203% versus 127.5. Then it changed. It changed on the exact date of May 10th. You would have been better off at that point in time to sell out of the equal weighted index and go over to the RSP, to the cap weight, or to the sell out of the cap weighted index and go to the equal weighted index. Then it changed again in 2008 through 2009, 2009 through 2013. this symbol actually continues as we sit here today. So on a buy and hold basis, how many people have heard their advisor or other people say, just buy and hold, throw it in the lockbox, don't worry about it? A lot of people in here. Everybody does that. Why? Because they're too lazy to pay attention for what you're paying them. Do not buy and hold. Does not work. Does not work. Unless you plan on buying something and you know deep down inside that Warren Buffett's going to be here for another 200 years, and you want to buy Berkshire Hathaway and just lock it away in a lockbox. Because you've got to pay attention, and especially in today's technology world that everything's moving, your advisor has to pay attention. If you buy and hold the cap-weighted index, which is Congress, you'd be up 298%. Not a bad performance number. I don't think anybody would be too upset about that. But if you bought and hold the RSP, it'd be up 462. If using just what I call the silver bullet of relative strength, this is the silver bullet for investing. Relative strength is, you would have been up 595%. Difference of 132%. Take that on, and I'll just throw out $1 million portfolio. It's an extra $132,000. What can you do with an extra $132,000? Oh, you can pay the government, of course, and that may end up being more than that. But what you can do is you can actually take a cruise for 11 months and 3 weeks and hit 262 ports all over the world, and they will throw in free for you over that period of time, free laundry. So that's something that, keep in mind if you would do that. But you have one problem. From 2000, what's happened in the market? What have we seen happen? We've had the financial crisis. We've had the housing crisis. We had 9/11 that happened. We've had the European debt crisis. There have been a number of things that have happened out there. And most people and advisors don't have the intestinal fortitude to keep you in the marketplace. There are times to be in the market and there are times to be out of the market. There's times when it's raining, there's times when it's sunshining. There's times when it's snowing and minus 11 degrees, or people in Minneapolis probably minus 40 degrees without wind chill, and there's times when it's bright sunshiny. With the market, it's the same way. So what we did is we took that investment idea of comparing the S&P 500 versus the S&P equal weighted 500, and we said, you know what? Let's throw in money market. Let's add a participant to this. So we threw money market into the portfolio. We go all the way back, same numbers of 94 through, this was through 12/1 of 13. You'd had a 67% return in the money market account. Not bad. These numbers, none of these numbers include taxes or anything like that because everybody has different taxation. These are gross numbers. The S&P, just by the house, you'd be at 298%, as I'd mentioned previously. The Senate, you'd be 462. The switching would be 595. But the people's portfolio, where by using the silver bullet of relative strength, you will either be in the equal weighted index, the cap weighted index, or you will be in cash. Those are the only three participants. You'd have a 743% return. This is a portfolio management system you can use. You don't have to buy individual stocks. This is only 3 things. 3 things. Nobody's forecasting. Nobody's trying to figure out where the market's going to be in 2014, 2018, 2021, or 22. Does this feel like something you can use? Yeah? Up in the back? Yeah? Okay. I can't see that far up. I don't have my glasses on. need the cheaters. This is, with this people's portfolio, this is the original spot that we start with every individual client. This is always one part of the portfolio. Always one part. Because worst case scenario is, let's say you have to be in the cap weighted index where you're at least equaling what you're seeing on TV. Make sense? Okay. What we then do is we take it another step further with a silver bullet of relative strength, and we compare 6 different asset classes. We have cash, which is one, commodities, which is another area, fixed income, U.S. securities, currencies, international securities. So we basically have covered the world in the different asset classes. I designed a proprietary portfolio process that goes through all of these asset classes that has different areas to where we make sure that we represent the entire area. They each have different exchange-traded funds that are in there. Does everybody know what exchange-traded fund is? No? What exchange-traded fund is, it is a revolutionary product that came out about 25 years ago, and once again, nobody heard of until recently. What it does is it's like a mutual fund, but the difference is they will buy an index, where I mentioned earlier the housing index. They will buy an index, put it together, and it trades in real time, meaning we can buy it in the morning and sell it 2 seconds later, if we so choose. So it trades as a stock. The fees are much less than being in a mutual fund. I actually wrote an article, and I think it was 2 months ago, that it was in Agency Sales Magazine, and it was about a friend of mine who sat on a board committee, and being on the committee, and he was an investment advisor, the brokerage firm that was managing the portfolio had actually bought what was called PTRAX, which is a PIMCO Total Return Fund. And he questioned them and said, well, why don't you buy the iShare of the PIMCO Total Return Fund that is less expensive to us, the client, in internal management fees, and has a better performance number? And they said, no, you'd have to pay a commission. He was paying attention to what was happening. These other guys were not paying attention. But what we do with this, comparing one asset class to another, it's actually called Dolly. And we run this on a daily basis, and what it does is it tells us exactly where in the world to focus your investments. Where in the world to focus your investments. What we do is we run, and it's basically an arm wrestling contest, where we take all the participants together, line them up in a room, and we have them arm wrestle each other till each index is arm wrestled the other. And then what we do is we find out the number of winners, place them into a matrix, take the top 2 asset classes. We then concentrate on those areas, and the final thing that they do is they go against the money market account. So if they outperform the money market account, we are then placing our dollars in that asset class. As we sit here today, the domestic equities is the number 1 asset class, has been for a while. Number 2 is international equities, which you may find alarming with all the problems we've heard about happening overseas. But we then take those areas, which I'll get into later, and drill down a little bit further. The guidance that Dolly did, I told you in the beginning, I was going to give you exactly how we stayed out of the market in 2008 and made our portfolios profitable. This was based on doing the relative strength with the asset classes. Basically what you're seeing on this is starting in 2008, we had money market and commodities. What had taken, money market actually took the place of international equities that had been in the portfolio for almost 9 out of the previous 10 years. It was the number 1 or number 2 ranked asset class. International equities got kicked out and was replaced by money markets. So starting in January 4th of 2008, we did not own one equity whatsoever in our portfolios. We were 50% money market, 50% in the commodities market. Then what happened in March of 2008, foreign currencies came in, kicked money market out. So we were in foreign currencies and money market and commodities. Commodities was booted out on July 23rd of 2008. Guess what happened in August of 2008 to the commodities market? Went to a cliff and it fell over. Commodities in 2008 in August were decimated. Decimated. Did we know that was going to happen? Absolutely not. We did not know that was going to happen. But the portfolio process of relative strength, going all the way back to Econ 101 of supply and demand, told us to get out of it. We did not question it. We did not become emotional. We followed the investment process as it told us to do, which, believe it or not, takes a lot of intestinal fortitude because it's counterintuitive. There's many times you're looking at it and you're going, oh my, everything I'm reading, everything I'm hearing, everybody I'm talking to is saying it's positive, and I'm selling? I had clients in July that would call me and go, why are we getting out of commodities? We're going on vacation and I see gas and oil prices going straight through the roof, and you're selling them. They didn't bother to call me back in August. They just said thank you. Then what happened in 10/1 of 2008, we owned money market. We owned the money market account. 2008, we were sitting 100% money market account, and yes, my clients were paying me to have them in a money market account that was paying less than 1%. My clients were happy. The reason they were happy is they were not in the debacle of seeing everything going south. You had mentioned earlier that your father had a portfolio, and basically a lot of people saw their portfolio cut in half, some substantially more, some substantially less. Problem though was, when that happened, they said, I'm getting out. I'm not letting it go down. I'm not letting my $100,000 go to 25. I'm going to take my lumps at 50,000. I'm going to get out, or at 60,000, or whatever number you happen to get at that time. And then they never got back in. They never got back in the game. Our process actually told us, go back into international equities in January 2nd of 2009. We put 50% of the portfolio to work in international equities at that point in time. Turned right around, and as I told you, usually they give a long-term signal. This case, it did not. It was 12 days. We lost 4% in 12 days. Doesn't always work perfectly. A lot of explaining to clients, but the process, we said we have to follow the process because it just got us out, told us to get back in, and guess what? It was a head fake. It's not a perfect process, but it's the best thing we have out there today. It's kind of like the U.S. Democracy is not a perfect process, but it's the best thing going today. And then we turned around, and commodities came back in March. International equities and commodities, as you can see, international equities were held through. And as we're sitting, it was international equities and domestic equities, which is where we are today. Would something like this have helped you in 2008 if you were in the market? Yeah. Our clients were very, very, very happy. This gives you actually the chart of the S&P 500. This is the cap-weighted S&P 500. And it gives you a chart, and I know this may be a little difficult to read, but what you're looking at is from January of 2000 through 2003, fixed income and commodities and money market were the top three. That's where the majority of our funds were. And as you can see, the market went down through that period of time. Then all of a sudden, the market changes from January 3rd through 2008. International equities and commodities held the top two positions. Domestic equities were in third, but these were the top two performers that we used. International equities came out in 2008, as I had mentioned, and as we go through the process. But that gives you a flavor for actually going back from 2000 all the way through and showing you how using the silver bullet of relative strength can actually impact your portfolio. And it's fourth grade math and paying attention. It's not difficult. I always tell people, there's a big thing out there right now with the NFL, and they're talking about concussions and how they're trying to pay these guys back who used to play, because what would happen is you get hit in the head, get a concussion, they throw you back in the game. Well, I was a Division III football player, and I had 6 concussions. So I'm not the smartest hack in the woodshed, but I'm able to use an investment process that is built on supply and demand and fourth grade math, and it makes our clients' portfolios very profitable. And it's simplistic and it's easy to do. You can do this yourself. We then take it a step further. This is actually an example of different sectors that we have out there. We follow 43 different sectors that are out there for the marketplace. Number one is, and this is as of December, number one is the aerospace industry, the gaming industry, internet, textiles, and the building industry are the top 5. But the reason I put this up here is we've drilled down and now and gone a step further. We're involved in the U.S. equity market right now. Question then becomes, where in the U.S. equity market do we buy? Well, the first answer we already know is we should own the S&P equal weighted index. That's the first answer. Second answer is let's drill a little further. Let's try to find things that are outperforming the S&P equity index, the equal weighted index. Out of these 43 sectors, this is another portfolio management system that you can use. We take every one of these 43 different sectors, and they have a wrestling match, as I mentioned, against each other. We take the number of winners, and we then rank them. Back to the ranking system again. And we rank them. And we then say, let's go into the aerospace industry. We take all the stocks in the aerospace industry and we rank them in this matrix system. And we can take, it depends on the client's tolerance for risk, we can buy the top 5, we can buy the top 15, depends on where you are. Once it hits below the 50% level or even the 20% level, it depends on what the client's looking for, we kick that one out and buy the next one. Does that make sense? We do this for international equities on a country basis. We can go to China, we can go to Turkey, we can go to Saudi Arabia, we can go to Indonesia, we can go to Germany, we can go to Brazil, we can go anywhere in the world that you would want to trade, where you would want to invest your dollars, and we can tell you what the best performing securities are in that place, at that country, at that period of time. Doesn't matter. Do it in the U.S. You want to figure out what the best equities are in the U.S. in your industry, we can do the same thing. Does this make sense to everybody? And I keep going back to that. I see a lot of the shaking of the heads, but I hope it's not that you're falling asleep on me. But utilize it. Anybody in here have a 401k plan? Yeah. How do you choose? Well, let's go to Clint, the smart guy here in the room. Clint, how do you choose where to put your money in your 401k? The other guy. Well, I mean, the other guy.
Yeah.
Okay. What does he do?
Put us in, I don't even know. I mean, my wife watches it, that's why I'm
Okay.
doing some work.
Well, it's basically a WAG, as you had mentioned before, right?
That's right.
What we do with people that own individual equities, and this has been the fastest growing part of our business, because everybody has a 401k at work. What we do is we take the options that you have available, we place them into our matrix system, put the S&P equal weighted index as one of those options, and we then rank them. Would it be of value to you to know what the top performers are in your portfolio options on your 401k today? Not last year, not 10 years ago, today. Would it make sense to have your dollars invested in the best performing funds today? It's kind of like, I'll go back to the sports analogy of the Cleveland Indians. The Cleveland Indians are always looking for pitching. And they buy the guy that 5 years ago was good because he's cheap. But he has nothing available to offer. You want to have the top performers today. That's how you win championships, and that's how you increase your portfolio, by having the best of the best today. It's what is working today, not tomorrow. Yes, ma'am?
It's like he was saying, most of us have a guide.
Right.
And I don't really know if those guys are looking at what you're talking about here, because it makes you wonder. I'm wondering a lot more now than I was before I'm in here. If they're looking at what's best for them, or if they're looking at what's best for the client.
Mm-hmm.
And that's what I see a lot. You have these investment people that you're working with, and they're all a part of another group, like a Transamerica or,
Correct.
or Crimco or whomever.
Mm-hmm.
So, yeah, how do we know? I mean, this might not be the right time for that, but how do we know they're looking out for us and not looking out for themselves?
You don't. And the question, everybody could hear a question, how do you know that the person you're working with is looking out for you and not looking out for the company that they work for? You do not know the answer to that question. However, the first question you should ask these people is, how are you choosing where I should place my investment dollars? Exact same as what I used with Clint. What investment philosophy are you using? When I learned this philosophy in 1999, I was actually walking by, and his name is Will. He was my mentor for a few years in the business. And I'm walking by his office, and I'm down in the dumps because, by God, everything I bought, if I bought it, it was going down. You can guarantee it. I bought it that day, you were better off to do what's called sell it short, which is when you make money with the market going down. Best thing you could ever do. And he sat me down and he goes, Roger, how do you choose stocks? What's your process? And I looked at him and I go, I don't know a doggone thing about the market. Now, mind you, I had been in the business for 14 years before that. I did what I was told by the firm. I pushed the stocks that the firm told me. I pushed the stocks and the investment ideas that, I'll be very honest to you, paid me well.
Right.
They paid me very well. And I may get a call from a client saying, why'd you put me in that? Just hold on to it, it'll come back. The market always comes back. You know, the market average is 10%, going all the way back to 1900. I think the number they use is 1925. Do you have from 1925 through 2000? That's a long time. That's a long time. So to answer your question, that's what you ask them. What investment process are you using? And they may come up with an idea that's called asset allocation. Pie chart? Anybody ever seen these pie charts that they have? With the pie charts, what are they telling you? What they're telling you with the pie chart is, I have no idea where in the hell we're going, but yet we're going to drive down the street and we're not going to look facing forward. We're going to look and use our rearview mirror. What happens? You crash. The silliest idea is asset allocation, and the main reason why is anybody in here a principal that owns the firm? And with you guys that own the firm, here's what I want you to do, starting now. First thing I want you to do, I want you to go in, I want you to fire your number one producer. Your number one salesman, fire him. Take his territory and give it to the lowest producer you have. Does that make sense? Why? That's what asset allocation tells you. Take from the good and give more to the bad. It's like, I go to the Kentucky Derby every year. I love the horses. And you sit down and watch the horses, and you know what? That tells you, shoot the fastest horse. Horse wins the Kentucky Derby, shoot it. That's what asset allocation is telling you to do. And the guy who came in last place, that's the one you bet on going into the Preakness. Doesn't make sense. Does not make sense. You take the number one performers, usually they're going to be a little bit better. They may not be the number one performer next year, but I guarantee you they're going to be in the top 5 and they're going to make you money. So you ask them, how do you choose the investments for us? And if they give you the asset allocation, term is, thank you very much, have a nice day, pick the phone up and call me. Now, when you're dealing, you say the institutional guys, we do not manage the total portfolio. We will take Cliff, and we'll say, Cliff, you and I are going to sit down here, we're going to look at your individual 401k account. And Cliff and I go through what Cliff is trying to accomplish. I then tell Cliff, I say, Cliff, you know what, you need 20%, boom, 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 in these 5 different areas. I can either go into Cliff's account and do that for him, if he chooses to have me do it, or I can just tell Cliff, and then when there's a change, I call him. And I say, now Cliff, I know you're on the road here, buddy, but you need to make a change tomorrow, and this is what you need to allocate it, boom, boom, boom. We can do it by email. But what it is we are constantly running these numbers on a daily basis and paying attention. And with the computer power that we have now, we can run an infinite amount of numbers. And if you look at your 401k plan, you're able to be in the best of the best at any point in time. It's kind of long drawn. Sir, question.
How often do you talk to your clients? Because obviously the market moves. And if you ask most people in here, we're lucky if we get them once a quarter.
I barely ever talk to my clients.
Okay?
And the main reason why is I tell my clients, when you look at your statement, there's a this period value and a last period value. If it's up, and it's up more than the S&P equal weighted index, what do you want to talk about? You want to ask me how my kids are? You want to know what's going on? I'm always there. I'm a phone call away. It's on 24/7. You call, I answer. I will answer any question that you choose to answer. Do I proactively call you on the phone and say, you know what, Bob, I need to talk to you about this? All of my accounts are done in real time with 100% discretion. Because that saves me time, because I want to get the best price for everybody, and it saves me time and money and effort, as opposed to sitting down. You're in a sales presentation. You want my phone ringing, your phone ringing, it's me on the other end of the line saying, you know, Bob, we need to buy ABC and sell XYZ. You go, Raj, I'm making real money here. Have a nice day. Don't call me. But if we have clients that call, we answer any question. I had a client who lives in Florida, just came up last week from Akron, or into Akron, and he goes, I'm in town, Raj, can we get together? We went, sat down, started at breakfast, went to lunch, and ended up at dinner. And we sat down, and I answered any and every question that he possibly has. I have another client that runs a company called Tremco Corporation. He was looking at buying a property at Peak and Peak. He called me up. We had a 20, 25-minute conversation to where I answered all the questions that he has. So I guess to answer your question, I'm there and available as you need me. But am I proactively going out bothering clients? No. Question?
Yeah, my guy swears on the 200-day moving average. What do you think?
Depends on what stock you're using. And let's say, what question is his investment advisor uses what's called the 200-day moving average, which basically is over the past 200 days, they take every single number on what this stock is traded at, and if it trades below the 200-day,
He puts a 3%.
he puts a 3% movement on the stock. Well, if you have a stock that goes, which Apple can do in one day, the 3%,
Yeah, that's nothing.
you know what's going to happen? It's going to hit under the 3% and turn around and move. Stocks today are moving much more than 2, 3, 4%. The term is volatility of moving around.
Fund, municipal.
Municipal bonds?
Yeah.
If he's got your municipal bonds, turn around and run tail. Because in municipal,
Market is bad.
I would not own the bond market right now. Would not own the bond market. Reason being, with our portfolios, fixed income, where we compare each asset class, fixed income is at the bottom. And let me just kind of from a fundamental reason, not technical reason, which way do you think interest rates are going to go? They're almost at zero now. So which way do you think they're going? Up or down? So if they go up,
Bonds.
your principal value goes down in your bonds. And if you own a bond fund, it's even worse because they never come due. They never mature. If you own an individual bond, the thing is, you get your money back at the end. But this works. I mean, if you have any other questions, let me know. Give me a shout. But to me, to have somebody manage your individual 401k works top.
So if you're buying and selling quite often, then what is your philosophy of short-term and long-term?
We have nothing to do with short-term, long-term gains. We deal with what the portfolio tells us to do and what our indicators tell us to do. That would be something with dealing with your accountant. And the way I usually answer the question, would you be happy on the ITB to pay taxes on 112%? Probably. So we do not look at that. We only do the investment side. I know there are other people that are out there that are CPAs that will tell you we'll take care of your taxes, we'll take care of your insurance, we'll take care of your pension, we'll take care of your succession planning. And my personal opinion is, I don't want a podiatrist doing my heart surgery. I want my CPA doing my taxes. I want my insurance guy doing my insurance. I want my investment guy doing my investments only. I don't believe, and this is my personal opinion, I don't believe you can do everything. You cannot be a jack of all trades.
But if there's going to be a short-term gain, then do it just to get out.
Right, well, is it better off to have a short-term gain than losing money? Does that answer your question? Okay. This is a very unique chart. This was actually a study that was done starting in 2000. What they did is they took 4 different areas, 4 different people. Number 1 is Mr. Buy and Hold. Mr. Buy and Hold put his $10,000 in, held it through 2011, and his return was minus 1.29. Mr. Perfect Market Timing, Clint over here, with his WAG philosophy, he has perfect market timing. He put $10,000 in, he got in the market at the right time, out of the market at the right time, it was 8.35%. Buying and holding, or buying the best performing sector each and every year in the beginning of January, you'd be up 22.95%, and buying the worst performing, you'd be up 18.64. What I'm trying to show you here is stocks move in and out of season the exact same way produce does in the supermarket. We buy winter squash in the winter, we buy summer squash in the summer. We buy tomatoes in the summer because they're cheaper and taste better than they do in January where they're more expensive. I'm going to hit the last part here because I want to make sure I get everybody over to the lunch meeting and give you a chance to hit the areas. We are in what's called a structural bull market. What this is is this is actually a chart that was from Dorsey, Wright and Associates. It's the structural markets of the Dow Jones Industrial Average going all the way back to 1896 through June of 2013. And what you see here in the green, those are the bull markets, and in the red are the bear markets. We go bull market, bear market, bull market, bear market. Don't need to tell everybody, but recently we're in for the past 10 years in a bear market. We do not forecast where the market is. This is actually looking back at past history. But utilizing the technical analysis that's out there, we believe we have been in a structural bull market since 2009. We believe that we have been in a bull market since 2009. Back in 2000, we called it a structural fair market. What a fair market means is there were going to be times when the market went up, you had to take advantage of it, times when the market went down. But basically, the market was going to stay flat over that time. The reason we have this long-term structural bull market observations is U.S. equities have held in our asset class mix the top position for the past 2.5 years. Prior year, if you go back to the other charts, a big difference. Big, big difference. Bullish trend. What a trend is where that chart's showing it going up, is there, and every U.S. equity benchmark is hitting new highs. That's telling you something's happening out there. There are more buyers than sellers. Demand is in control, supply is not. Over the past 2.5 years, 9 out of 10 U.S. large cap stocks are trading in a positive overall trend. What that means is they're heading up. All of that is telling us, yes, we may see the market pull back. We don't know. But when the market pulls back, that may be a time to start looking at certain areas. There is a time to be in the market. There's a time to be out of the market. Right now is the time to be in the market. More fuel. This is relatively new slide that came out. It came out from the Fed Board of Governors of the Federal Reserve System. It's the household financial obligations is a percentage of disposable personal income. This is actually a line chart, a little tougher to read than the point and figure charts that are very simplistic. But basically what this is saying, if you go all the way back to 1980, we had your financial obligations such as your mortgage, your car payments, and what have you, just basic things to keep your household going. We're all the way down a little bit over the 15% range. Went up, and this actually, through this period of time, guess what we had there? We had a bull market. Market went up. Right now we're sitting at the levels of 1982, where consumers are actually, and this may be good for you guys, consumers are actually feeling more comfortable. They're starting to spend more money. They're going to be becoming more leveraged in the future because they've de-leveraged themselves. They've sold out. They've taken their credit card debt down. So this may add more fuel to the market. Once again, not guaranteeing, not forecasting. It's just paying attention. It's an observation. Another thing that, Libby, I guarantee you, if you take this slide, that your broker's not using. And if anybody wants copies of the slides, shoot me an email. More than happy to send them out to you. And sign up for our 2-Minute Tuesday that we do have. We just send an email out to you, and you go to the YouTube, you press it on, you're going to hear my voice, and it'll give you somewhat of a flavor and an idea for what's happening. If you are in the 401k and you want to know what are the top performers, send me over a copy of just your options. I don't need the individual portfolio, just your options. Or if you want to say, this is what I'm in, these are the percentages, I do not want the numbers. I don't want you to say I have 25,000 here, 50,000 there. Say I've got 10% in the American funds, the Fundamental Investors Fund. I've got 15% here. We will then go through that, show you which ones are not outperforming the market, the S&P Equal Weighted Index, and then we will show you, as a free service, first time, we will show you what 5 you should actually own, or what ones you should own based upon your portfolio. We already went through the questions. There's a little. Any other questions you guys have? Anything at all? You got me here now.
What do you charge for your services?
A lot.
That's what it should be.
A lot. No, basically where we start, if it's on the 401k plan side and we are actually going in and making the choices for you, it's around 1.25%, and that's based on a quarterly basis. So if your account goes up, we make more money, you make more money. The account goes down, we still get paid, but you are still losing. So it's kind of we try to make it a win-win situation for everybody. So you're right near 1.25%. The key thing about using a financial advisor such as myself, that I used to be with the big brokerage firms, as you heard in the introduction, the difference is the transaction fees are paid by you. We have nothing to do with the transaction fees. We use a discount brokerage firm. We can use, say you're at Schwab right now, we can use Schwab. You don't have to take your account and change it and move it to us unless you choose to do that. We then have access to your account. And we just go in and make the trades for you. You get an email or a phone call, and we say, you know what, we just changed from ABC, sold that out, and went to XYZ. And it's on a quarterly basis. Any other questions?
How do we sign up for 2 Minute Tuesday?
Go to our website, which is www.balserwealth, BALSER, WEALTH.com, or give me a card on the way out. We'll make sure we get you on the 2 Minute Tuesday.
BALSER,
wealth.com.
Yeah.
And it's on the website. There's different information that's on there. But what we try to do mostly, and what I try to do here, is just give you an education and let you know that there are options out there that are available to you. And this is not something that I designed, that I developed. It's been around for 100 years. It's a lost art. We used to have most of the major brokerage firms all had a technical analysis department. They fired every one of them. They don't have them anymore. Folks like me are out there doing this, and with a computer power, it's very simplistic. We press a button and it goes through. And then you make the changes. The hardest part, and I struggle with this every day, is when it's going up and it tells you to sell, it's still hard for me to do this.
The emotions.
It's still hard. Because you have that doubt in your mind of, well, I know this thing works, but what if it doesn't? And then you press the button and it works and you go, thank God, it still works. After 100 years, there must be something to it. Any other questions? We're all set. I'll be around as long as you need. If you want to ask questions, let me know. My phone number is on everything. If you want a card, let me know. Please feel free to give me a call if you have questions. That's what we're here for. That's what we're. Plus, what I would also recommend to you is we're doing another presentation on Friday. It's called Living the American Dream. Success is not an accident. That one is a little bit different, but it may help you change your life and change your business. Sir?
Will it be in this room?
I think it's in this room. It is 10:45?
Yeah.
10:45 on Friday. That's my commercial for you.
Good job.
Thank you, appreciate it. Sure. Let me turn this off as I look through here.